Morning, thanks much. Well, what impressed you most?
Well, Sridhar, there were a lot of positives for the results. Obviously, it met consensus estimates by a long margin.
Yes.
And number two is that they have said that there's some resolution happening on their pension scheme, which was a big issue. And number three is that, debt has actually come down quarter on quarter. So these are the three positives which market is enthused about, and most analysts would be looking to upgrade the numbers. But, if you look at the bigger picture, things have actually already moved on from where things were. This is a reflection of past. Meaning inventories of steel are at all-time high that we have seen in the recent past. And demand has also kind of peaked out globally. And steel prices have been actually starting to come down in China. So steel market per se doesn't look that exciting as it was in 2016 calendar year. Number two is that, there's a lot of expectation that now there will be free cash flow generation and debt for Tata Steel will come down. But, they are mentioning that there's a 550 million pound hit they have to take when they move to a new pension scheme. And that, if you combine with the capex, which is going to stay almost flattish next year, I don't think that is going to come down in FY18. So that's the second part. So, overall, when I look at it, obviously, stock will react positively. But, the future is not looking as bright, or things are not really going up.
Okay. Rakesh, good morning. In that case, do you see this, if the stock rallies, do you see this as an opportunity for those who got in early at the low of the cycle to, lighten up their positions? Or do you see in the medium term some signs of re-rating for the sector and the stock?
So, Anuj, as I've been mentioning for quite some time on a channel that, middle of 2017 is where we think commodity stocks are going to peak out. So universally, I can say that, yes, that stands true. But for Tata Steel, people have to do their own valuation and etc. To figure out whether they want to hold on or not. But generally for metals, I would say that the best is behind us. And especially for steel, meaning whatever government support could have come in has already come, whether it was safeguard duty or import duty or now, the other things that they have imposed. I don't think government can do anything further. So if global steel prices are going to come down, which they are starting to, Indian steel prices will also get impacted and margins will come down.
Okay. Rakesh, morning. I'll come back to the steel prices in a bit. But before that, the Achilles heel for Tata Steel for the longest time has been its debt. And historically, if you see, whenever the debt of the company is brought down, the stock sort of tends to rally and at least be upbeat. This time around, too, net debt has gone down significantly. You think at least that will keep the stock afloat?
Yes, net debt has gone down on quarter-on-quarter basis, but for the year FY17, it's ended up like 1,000 crore higher than last year.
Okay.
And so FY18, as I was mentioning, given the charge that they'll face on the pension liability, plus the remaining capex that they need to do, I find it difficult that the debt will come down substantially. Okay. So, which is what the expectation is building in. I think they'll have to wait for another year or so. And then maybe, who knows, Tata Steel goes and starts doing expansion again, which they're already hinting on the second phase of Kalinganagar.
Okay. So, would you say at 456 fairly valued?
Well, see, Lata, I can't talk about recommendations and valuation. But see, obviously, it's a big beat and there will be positive sentiment around it. But as I mentioned, that the scenario for the steel industry per se seems to have peaked out. So investors need to take a call in that backdrop. As to what has happened in the past, there's no guarantee it will happen in future again.
So when you say peaked out, what are you penciling in for the EBITDA per ton? Because this time the numbers look phenomenal. $100 for Europe, $185 for India. This is the best that we're going to see?
I would tend to think so, because there's a timing mismatch, meaning commodity prices went up, rather the raw material prices went up with a lag as compared to steel price. And so there's normally a mismatch when you look at quarterly numbers. So one has to look at, rather a trend, which is like a yearly trend. So in this quarter, I would say that there's a large part can be explained by mismatch, and also the sharp increase in ferroalloy prices. because it's a small business, so most analysts tend to miss it. They don't really model it.
Yep.
So the big beat has actually come from ferroalloys. Now, all these, are kind of one-offs, I would say. The sustainable level would be lower. So we can't really analyze these results.
Okay. Rakesh, would you have similar view on JSW Steel as well? Of course, the numbers are awaited today, but broadly, same view, or are you more positive on JSW Steel?
No, so there's a structural difference between both businesses. See, Tata Steel's 42% of volumes are coming from India, which are fully integrated for iron ore and 50% integrated for coking coal. So as raw material prices goes up and steel prices goes up, their margins expand. This will not be the case for JSW, because they are not integrated at all. So they won't really see the same margin expansion. And so to that extent, you can't really, compare these two. But obviously, JSW will also benefit because Indian iron ore prices don't really move up that much.
Okay. Yeah. Well, fair enough. Thank you very much, Rakesh, for stopping by this morning and giving us your views on Tata Steel as well as on JSW. Speaking of commodities, let's get the